Welcome to Sales Accelerators, Winning Strategies for Financial Professionals, an educational webinar series that explores the latest tools and concepts to help boost your sales performance and drive business growth. Join us as we analyze trending topics in life insurance, investigate the latest headlines, and discuss solutions to accommodate your clients' unique needs. Please welcome your host, Kurt Fasen, Executive Vice President of Sales and Marketing.
Hello, everyone. Welcome to another edition of Sales Accelerators. My name is Kurt Fasen, Executive Vice President here at DBS, and this is the program that we've designed to help you increase your sales with new ideas. Now, today's format is going to be a little bit different. We've invited several of our carriers that represent the asset-based hybrid solution or long-term care space. And this really gives you an opportunity to start understanding what are the differences? How would my client fit? What's the profile of the client that would need such a product? Our hope is that you'll get a better understanding of the options and how you can guide your clients through the matrix of trying to figure out what the best solution would be for their unique needs. So let's introduce our panel. First, I'd like to introduce Rob Johnson, representing Lincoln Financial MoneyGuard. Rob has been a frequent guest on this program and is well versed in the space with decades of experience. Rob, welcome back.
Awesome. Thanks for having me, Kurt.
Absolutely. Next up, we have Kimberly Lipps, representing John Hancock's LifeCare solution. And that is the newest entrance on our platform as a asset-based hybrid. Like Rob, Kimberly has a great deal of experience with long-term care solutions, and she's going to provide some great insights for us today. Thanks for being here with us today, Kimberly.
Thanks, Kurt. Appreciate the opportunity.
Absolutely. Then we have Joseph Taylor with Nationwide CareMatters. Joe has also years of experience and will provide us a lot of unique insights on our topic today. Joe, I'm glad you're with us today.
Thanks for having me, Kurt.
Absolutely. And finally, last but not least, Tim Go from Securian with their SecureCare solution. Tim really understands the link benefit space, and he's going to give us some great perspectives as well. Great to have you, Tim.
Thanks, Kurt. Good to be here.
All right. Well, that's our panel for today. So before we get into specifics, I'd like to just remind everybody joining, whether you're joining on a podcast version of this or with us online, find your webinar action plan. Now, if you're like I was when I was an advisor in the field, you now said, what's a webinar action plan? All right, if you don't know what that is, just get a sheet of paper. Now, on that sheet of paper, I want you to start thinking about your clients. What clients do you have? And as we start going through today, you should start gaining a good understanding of what carriers' products fit where. Where's their sweet spot? What niches they have? And of course, along the way, you can always call us here at DBS, either your case design analyst or your regional sales director. They can also help you guide towards a solution that'll fit your client's profile. All right, let's jump in. I think starting with long-term care in general is a good place to start because it'll help us understand the real need that the clients face. So Joe, I'm going to begin with you. Can you talk a little bit why a plan for long-term care is just so essential?
Absolutely, Kurt. I can definitely start with that. Long-term care planning is more important than ever today for a handful of reasons. And I think first, the risk is real and it's growing. People are living longer. They want to be healthier, which naturally they're going to linger, and the longer that they are alive, the more likely that they're going to need some care as they get towards the end of their life. So that's likely going to result in some form of extended care need. And you may have heard the stat, but it's still relevant today that 70% of people over the age of 65 are going to need some form of long-term care during their lifetime. So it just really shows that this risk is real and a long-term care plan is necessary. The cost of care is continuing to rise, not just with inflation, today, but the different types of care are more and more expensive. At-home care, whether you're in an assisted living facility. Some nursing facilities can exceed over $100,000 in cost per year. And these costs aren't covered by Medicare. And Medicaid's not going to kick in until you've spent down your assets significantly. So having a plan in place can help, protect your assets that way and help cover those rising costs. It also really helps protect your family and leave a legacy. You don't want to put a burden on your children or your family members if you don't have a plan in place. Having a long-term care plan can really help get around some of those challenges when it comes to a family member who needs extended care. And if you have a plan in place, it just gives you more choice and control about the type of care that you want to have, whether you want to receive care at home or whether you need to receive care in a facility. It just gives you that choice and control to plan for your extended care event. So long-term care planning, like I said, is more important than ever. And it definitely needs to be a part of your conversations with your clients if they're not already bringing it up to you.
Well said. I think it can be, it can be an issue that can be devastating to families, both financially and emotionally. If you're responsible, I've been in this position where I was responsible for coordinating caregiving. It's a lot. It's a lot. And when we talk about long-term care and what services are available for those with needs and all of that, what are the options? Tim, maybe I'll turn to you. Can you maybe share what we're talking about specifically when we're talking about what type of needs people are going to have in long-term care?
Yeah, absolutely, Kurt. Yeah, when we talk about long-term care, we're really referring to, a broad range of services designed to help people who can no longer perform everyday activities of their own. So what we call activities of daily living, or ADLs. These include things like bathing, dressing, eating, using the bathroom, or moving around freely and safely. So long-term care, it's not limited to nursing homes. Oftentimes when you hear long-term care, you think nursing homes. Long-term care covers a continuum of support based on someone's level of need. So for example, one option is home care, where a healthcare aide or a nurse or a family member or a friend comes to the person's home to help with medical needs or personal care. This allows people to stay in a familiar environment for as long as possible, which many families prefer. Then it kind of graduates to assisted living, which provides a balance between independence and support. Now, residents typically have their own apartment or their own room, but they can receive help with meals, medication management, daily tasks, along with access to like social activities and community life. And then really the highest level of care is skilled nursing care, what most people think of as a nursing home. So these facilities will provide 24-hour medical supervision, rehabilitation services for individuals with significant health needs. So when we're talking about long-term care, it's really about meeting people where they are. It's recognizing that extended care is a journey. It will start in one and really graduate through different types of care as a condition worsens or matures. So providing that right level of assistance, whether it's at home or an assisted living community or in a skilled care setting, supports both their health and their dignity over time.
That's very helpful. Thank you. I mean, as you think about this, Joe says 7 out of 10 of us will need something. And then Tim, you did a great job of kind of walking us through how it would be that we would get such care. But Rob, when we think about how we're going to pay for this stuff, there isn't just a one size fits all. There are many different ways people pay for long-term care. Can you maybe walk through the categories of how people fund long-term care solutions?
Yeah, most certainly. And the options have changed a ton over the last 50 years. For the first 15 to 20 years, the primary LTC insurance solution to fund long-term care planning was the traditional standalone LTC insurance policy. At one point, there were almost 100 insurance carriers offering that type of standalone at pay-as-you-go policy. Today, there's about 12. Certainly the lowest cost entrants option into funding long-term care. There's also life insurance with long-term care or chronic illness riders. Those are life policies. They could be permanent policies on an IUL or a VUL chassis with a long-term care rider. There's also annuity and LTC combination products. So and then we talk about hybrid, what we're talking about today, asset-based or hybrid LTC policies, and we'll get more into depth into that. And then of course, self-funding. Not one of these options is perfect for everyone. It's almost like going to a restaurant. Not everything on the menu is going to be perfect for everyone. So depending on the client's risk tolerance, how they're going to fund it, how long they want to fund it, where the money's coming on from, and maybe what stage they are in life is going to help determine which of these funding solutions will be most appropriate for them. And that's where my friends there at DBS can help you work down on that funnel between all of these options on which one would be best for your client's particular situation.
Yeah, that's perfect. Yeah, there's lots of options out there. There really are, and I think on one hand that's really good, right? It gives that optionality to clients to really figure out what fits their needs the best. But on the other side, it can be a little bit overwhelming, and clients can almost and advisors like yourself, you could get paralyzed. So that's where hopefully trying to help decipher today and kind of give you the decoding ring, if you will. So let's dig just a little bit deeper, because we all know that self-funding can be detrimental to a retirement portfolio. There's no way that it can't be. Traditional standalone also has some drawbacks. I can speak from experience. It does have drawbacks. And I know that everybody on this call, plus some of the other carriers we represent, you all have riders or you've got hybrid products that are available on your platform. So I think I want to start there. And Kimberly, we haven't heard from you yet. So maybe you could talk about the difference between the basic terms of riders and hybrid solutions and that type of thing.
Sure, I'd love to. With the optional riders that you can add on to permanent life insurance, normally called either chronic illness or then there's long-term care riders, there's going to be a rider charge in order to add them onto the policy, at least when there's upfront underwriting involved. There are some out there that have underwriting at time of claim and there's an actuarial calculation for the charge at that time, but most are going to have a charge to add them onto the policy. Most of these types of riders are going to allow early access to the death benefit. That's the way that they work, assuming the insured meets the qualifying definition. And then the monthly long-term care benefits are usually a percentage of the death benefit and generally received income tax-free. Now, at death, any remaining benefit on these types of policies is paid to the beneficiaries. So this structure ensures that the policy actually pays out, either for a long-term care benefit, as a death benefit, or maybe a combination of both. So it's going to be ideal for those clients who have a primary need for a permanent life insurance solution, but they want some long-term care protection without having to purchase a separate policy. Now, if we pivot to the asset-based long-term care, or interchangeably called hybrid long-term care products, with those, it's going to be a policy that combines both the long-term care insurance and long-term care benefits into one integrated product. Typically, they're going to include two benefit pools. There's going to be a death benefit, which is access first for long-term care needs. And then there's going to be this extension of benefits, which is an additional long-term care pool that's activated once the death benefits exhausted for long-term care. Now, if long-term care isn't needed, only the death benefit pool is paid to the beneficiaries. And if long-term care is required and that full death benefit has been accelerated, there's typically a small residual death benefit that might remain. Now, hybrid LTC products are designed primarily for long-term care planning, which offers then more robust long-term care coverage than the traditional life with the LTC riders that I talked about first. So in addition to the two pools, the benefits are designed to grow over time through inflation riders or market performance, which creates even greater leverage. Hybrid long-term care policies typically offer clients a transactional experience, both in terms of the application process and also premium payments. A lot of clients choose to reposition idle assets like CDs or savings accounts or other low-yielding accounts into a hybrid policy and then create greater efficiency with both the tax-free long-term care and death benefit protection.
Why might a person choose an asset-based long-term care product benefit structure?
I would say when the long-term care planning is more important to them than needing to have a death benefit that's still in place at time of death.
Yeah, that makes sense. So it's kind of a either or. I mean, both will give you a little bit of life insurance, both will give you a little bit of long-term care. And then depending upon which way that scale goes back and forth, that kind of helps direct you down one path or another. That's very good. Well, I think maybe now what we should do is let each of our panelists talk a little bit about their specific offerings and maybe invite all of you to specifically show the variety from all of these carriers, what you specifically have. Kimberly, you're the newest to the club, so we're going to start with you and give you the floor. Maybe you can talk just a little bit about what John Hancock has to offer, what makes you unique, and then why would an advisor look at LifeCare?
All right. Thanks so much. I really appreciate the opportunity, Kurt. So before I jump into the LifeCare product itself, I do think it's important to know our product team surveyed some of the largest distributors of hybrids nationally before going into product development, just to obtain feedback on any innovations they'd like to see with a new product launch. So I'm going to touch on 3 of the biggest asks that came out of those surveys. Let's start with growth and guarantees. So we've put LifeCare on an IUL chassis with a guaranteed premium. For growth, insureds can use an S&P 500 index to better keep up with long-term care inflation, which has averaged almost 5% annually over the past 10 years. And the Genworth Cost of Care study shows home care has been averaging 10% annual inflation over the prior 3 years. So very important to be able to have more substantial growth opportunity was one of the asks that came from the distributors. And even though it's on an IUL chassis, all the initial benefits are guaranteed to age 121. And then each time growth is credited, it receives a new high watermark, which is also locked into age 121. So basically, once benefits increase, they can't decrease no matter how the S&P performs. And then not only do the long-term care benefits grow with positive performance from the S&P, but our death benefit grows as well, providing more meaningful IRR in the event the client passes away and needs little or maybe no long-term care. You may know about Vitality, our wellness program that is automatically built in on LifeCare. So by doing things like your annual preventative care exam, wearing a device such as an Apple Watch or a Garmin to track steps, clients can receive additional growth credited to their long-term care and death benefits. And it's scientifically proven that engaging in a wellness program can prolong when and also reduce how long we need care. One of the basics, our issue ages are 30 to 75. I really encourage you to have longevity planning conversations with your clients at younger ages. Clients in their 30s and 40s, they get long-term care simply because they've probably seen a grandparent go through it. You don't have to design a plan that you would for your clients in their 50s and 60s. Instead, lock in those younger clients' insurability. Their health is one of their greatest assets. And then by utilizing performance-based growth, they can better keep up with or even potentially outpace long-term care inflation. Now, we were asked by distributors to provide flexibility with LifeCare. So we offer clients the choice between indemnity and reimbursement. They don't have to choose until time of claim, and we actually allow so much flexibility that they can actually switch back and forth between indemnity and reimbursement or over the course of the claim. Of course, we anticipate most clients are going to choose indemnity at least at initial onset of the claim. And those clients will get more when they need it because we do not reduce the monthly long-term care benefit when choosing indemnity. Now, we also offer 3 non-smoker risk classes, and I'm pleased to share that 40% of applications are being approved at preferred, which provides better leverage for that plan premium. In addition, our e-application process, which with that, many clients are, getting instant underwriting decisions, and we're averaging an 8-day turnaround from the date the application is in-house at Hancock to the date the policy is actually issued. Now, that does exclude 1035 exchanges, but it does include clients age 60 and older who are needing to get the cognitive screening. So definitely helps with closing percentages when there's not a long time lag between the date the client signs the application and the date you come back with the policy. So I hope what everyone takes away today is that LifeCare is a modernized approach to hybrid LTC that offers your clients more when they need it.
That's great. Kimberly, great overview. Thank you. Thanks for taking a few minutes to share that. I'm going to switch over to Rob over at Lincoln MoneyGuard. Rob, maybe you can share a little bit about what's unique and what situations or client types work really well for MoneyGuard.
Great. So MoneyGuard's been in the space. Most of you have known the name for a long time, for 37 years. There's not a carrier out there that's written more asset-based long-term care than Lincoln. We now are in the market with 2 different offerings. MoneyGuard Fixed Advantage for those clients in their 50s and 60s, or maybe early 70s, and then a market-driven version of MoneyGuard called MoneyGuard Market Advantage, generally, like Kimberly mentioned, to attract those folks that are younger and healthier and that have that longer runway before they are likely to need care. So let's talk about MoneyGuard Fixed Advantage first. When we think about these asset-based solutions, for a lot of folks, they think of live, quit, die solutions. I like to look at it as leverage, legacy, liquidity, generally. With MoneyGuard Fixed Advantage, I'll position this as leverage, guarantees, and choices. First of all the premiums and benefits, like my peers in this space, are guaranteed. That premium, the death benefit, the surrender value are all guaranteed. When it comes time to needing care, Lincoln MoneyGuard is the only carrier in this space that's not going to require an elimination period. There is no deductible. So when your client needs this, they paid for this 10, 15, 20, 30 years ago, those benefits, regardless of setting, are available day one. We're also going to provide more leverage than just about any other solution out there. So if we're looking at similar premium, similar benefit periods, my pool of money is going to be bigger than most of my peers in this space, meaning I'm going to give you more money and I'm going to give it to you sooner. I'm also going to give you a couple different choices. Now, we know if someone's buying long-term care today and our average buyer of Fixed Advantage is 60, our average buyer of Market Advantage is 50. We think about 20 to 30 years down the road, our average claim last year at Lincoln was age 83. I don't know 20 to 30 years from now, will my spouse be alive? Will he or she be able to provide care? Will my kids still live in the area? So like John Hancock, Lincoln's going to offer the option of indemnity or reimbursement at the time of claim. Now, we've gotten to the point where either the one individual has never needed care, they passed away, or they exhausted their benefits, eventually passed away. With Lincoln MoneyGuard, we're also going to give them the choice on what to do with the death benefit. So let's say the husband passed away, never needed his long-term care. He has a $100,000 death benefit. She, as the spouse and the beneficiary, is going to have the choice on what to do with that death benefit. She will have the option to either take the death benefit or take that death benefit and roll it back into her own MoneyGuard policy with no underwriting. And we're also going to take those dollars and we're going to leverage them by about 60% for long-term care. What's this really nice part about that is we're not going to do any additional underwriting, and it's available to her even if she's already on claim with Lincoln. So we're going to give someone that's uninsurable the option to get more long-term care And again, they don't need to make this decision until their spouse passes away. So two choices for them: choice at the time of claim, choice at the time of death. For those younger clients, our issue age is for Market Advantage, and this product's available in 49 states, every state except New York. Issue age is 30 to 70. Our average buyer of this is 50. And actually, this is what I own myself. There are 50 different sub-accounts from all the leading fund managers in the market. This plan offers uncapped market participation, annual lock-ins, a growing death benefit, and a 4 times multiplier whenever they need long-term care. So if we funded this over $5,000 over 20 years, our account grew to $400,000. I qualify for long-term care benefits. Now I have $1.6 million of tax-free LTC benefits. The nice part about Market Advantage is it also offers the indemnity and the benefit transfer option for the death benefit. So 2 different options. In fact, for couples, one individual, if he was in his 60s, could do the fixed version. If she's in her 50s, she could do the market-driven version, Market Advantage. So MoneyGuard Fixed Advantage, Market Advantage. Again, both products available in all states except the state of New York.
Rob, fantastic job as always, and boy, a lot of good stuff going on at Lincoln as well as Hancock. Let's hear from Joe. What's happening at Nationwide CareMatters? Joe, let's talk a little bit about what makes Nationwide unique and what makes their offerings stand out.
Yeah, Kurt, thanks. I'd love to get into our 2 hybrid long-term care options at Nationwide. Before I do that, let me just give a little bit of background of Nationwide and their history in the long-term care market. So Nationwide's been in the long-term care space for over 25 years now. We've had a long-term care rider that we could add to our life insurance-based solutions since 1999. We got into the hybrid space in 2014 with our first version of CareMatters. And now we're on our second iteration of CareMatters, CareMatters 2, which has been around for a handful of years now. And then we just introduced CareMatters Together, which is the first cash indemnity joint long-term care solution. And what all of Nationwide's long-term care options have in common, and what is unique with Nationwide, is that we have a 100% cash indemnity benefit. So you know exactly what your benefits are going to be at the time of claim. We're going to pay out 100% of that monthly benefit, no matter what your expenses are. So you don't have to, worry about getting reimbursed or collecting receipts in that sense. And ultimately, that just gives you more flexibility, as I was saying earlier, to choose the type of care that you want, whether that's at home or in a facility. The other aspect of that cash indemnity benefits is that we allow it to pay for 100% informal care. So you can pay family members and friends to be your primary caregivers, and we're going to put no restrictions on how you spend that money. So 100% cash indemnity benefits. The second unique feature to Nationwide is how our elimination period works. So we are going to have a 90 calendar day elimination period, but the way that ours works, and this is true for both of our solutions today, is that we're going to retroactively pay back those first 90 days. So talk about not only getting a large check in that 4th month after you've satisfied those 90 days, but getting through your premium dollars quicker and closer to the insurance carrier's pockets with that retroactive elimination period. Now, I think that's a great feature to mention too in your conversations, because people do bring that up. What am I going to do during those 90 days? Well, Nationwide's going to pay you back for that. Another unique feature that I'll say that is to Nationwide is that joint capability with CareMatters Together, the ability to add 2 lives on one policy and create a shared pool of long-term care. It really helps, eliminate those what ifs. I'll pick on us men here, but a lot of times men will say that they aren't ever going to need care. And they're not going to need a long-term care policy. Well, I'd ask them, what if you do? What if you do need care for 1 year or 2 years? Wouldn't it be nice to have a policy that could cover a portion of that care, or cover that claim for you, and then leave the remaining pool of long-term care to that surviving spouse? So it can help eliminate that what if of somebody who's not really, on board there, or just that whole ability to share the long-term care pool. We put no restrictions on how it could be split up. One person can use it all, or one person could not need any or use any of the benefits. I'll say this: I don't think that it's a disadvantage if one person uses 100% of that benefit. It just provides more time for you to plan for that second insured's needs. So don't overlook that shared pool capability. The other key feature with Nationwide is our residual death benefit. So we're going to have the highest residual death benefit of 20% on our CareMatters 2, our individual policy. So if you use every last dollar for long-term care, we're going to still pay 20% of that residual, or of that original specified amount. It is only 10% on our joint policy, but that one's really designed to maximize long-term care benefits, and death benefit is really not the primary objective.
Sure.
And the last thing I'll say about CareMatters Together that is unique and different than our individual option is the waiver of premium. So we have multiple payment options for both solutions. If you choose one of the extended payment options on CareMatters Together, and somebody goes on claim while you're scheduled to pay premiums, we're going to waive that premium. So there's 100% waiver of premium while somebody is receiving benefits. And so that just gives them the peace of mind that they don't have to worry about paying a premium while somebody is receiving or needing care. So Nationwide's got two options for individuals and our joint option, CareMatters Together. And yeah, that's CareMatters.
That sounds great, Joe. Great work. And yeah, it's nice to have that waiver, right? That takes a little bit of the sweat off the brow when if somebody is under claim, that they can just focus on what's most important and not worry about the premium payments at that point. All right. Well, now we have not heard yet from our friend Tim Go over at Securian, and I'd love to hear about the products and what makes Securian stand out in this area.
No, absolutely, Kurt. Thank you. So our primary long-term care solution is our asset-based solution, SecureCare 3, right? And really similar to Nationwide, our flagship feature, I would say, is cash indemnity. We are 100% cash indemnity. The leverage that you see on every illustration is going to be 100% guaranteed, right? So when it comes to the actual illustration, it's short, it's easy to understand, and it's fixed, right? So it's really more of a quote than it is an illustration. So really our simplicity, and then you look into the flexibility and the guarantees, which I'll kind of touch on later. As a product line, from a pricing standpoint, where we're seeing things right now, so we're having really strong traction with short pay lump sum scenarios, right? So SecureCare 3 is extremely competitive when clients want to make a lump sum premium or 5, 7, 10, 15 pay commitments, locking in guarantees without that long-term payment exposure. So it resonates with clients who have that lump sum sitting in a low yield account, or who may want to prefer to reposition existing assets for greater leverage. So currently SecureCare 3, it's providing some of the highest long-term care benefit multiples in the industry, especially for healthy clients in their 50s and 60s, right? So if you have, our age bracket is from 40 to 75. If you have a 40-year-old willing to do a short pay into SecureCare, it's going to look great. But really, we're looking at 50s to 60s. And if you have a couple, both healthy, it's going to be in their benefit to get 2 individual policies for planning. It's going to provide a lot of flexibility, a lot of leverage. So, I know Joe touched on it, but really the indemnity is such a strong story that I would be remiss if I wouldn't reinforce that, right? Once that client qualifies for benefits, they're receiving that monthly payment in cash. So no receipts, no pre-approval is required. They can use those dollars however they choose for home care, family caregivers, assisted living, and even services outside the U.S. SecureCare 3 has a tremendous international benefit. they have access to the full benefit. We limit them to 50% of their monthly max, but it really extends their benefit duration, right? So if they have a 6-year duration, it would turn into a 12-year duration. Also, our clients that have SecureCare, they have a lot of flexibility when it comes to, how they access that cash indemnity benefit. So obviously it's cash, right? So if they want to take that full benefit, might as well. But if they wanted to take less and they had an inflation rider on there, they have the flexibility to take less than their monthly max to stretch out their benefit pool longer if they want. So this really comes into play if their monthly benefit is greater than what the IRS per diem is at the time that they go on claim, right? That IRS per diem hopefully should continue to go up. But if they have a robust policy, they may be on the hook for taxes above that per diem, which really we want to give the client the flexibility to choose how they want to plan for receiving that benefit. So we give them that flexibility to take less if they want, even though, again, it sounds a little odd because it's cash indemnity. Also, with a waiver of premium, we offer waiver of premium at a very inexpensive rate on all of our policy designs for multi-pay, right? So 5, 7, 10, 15 payment durations, the client will have the option to purchase that waiver of premium. And then, structurally, right, again, 40 to 75, sweet spot's going to be 50 to 60. Pay schedules go from single pay to 15 pay. Benefit durations will be 4 to 8 years. And then we have 3%, 5%, simple and compound. Our 3% compound inflation is especially powerful, and it's very, very popular with most of our clients. And then from an advisor standpoint, it's really SecureCare is just an easy product to do business with, right? There are no parameds, no labs, not unlike my peers here on the panel here today, but it's a very simple process. Client will just have to complete an online questionnaire or a short interview or phone interview. And when it comes to claims, we have a care management team that supports the clients through the entire claims process, helping them access the care they need when they need it. So, and really, Kurt, in summary, SecureCare 3, really strong, single life, short pay scenarios, cash indemnity with a lot of flexibility, adjustable monthly benefit access, waiver of premium on all multi-pay designs, and a real simple, streamlined client and advisor experience.
That's perfect. Tim, thank you. Well, I think it's great to have all 4 of you with us here today because it really gives our audience a chance to hear a little bit more about what makes you different, what makes you tick. And we've had great experience. Our team, our advisors that work with us have had great experience with all 4 of you and your companies. And so now it's just a matter of making sure that everybody knows. I'm going to move to something we've not done before in this program, but I think it might be kind of fun. We're going to do a speed round. And I'm just going to use one question only. And in the speed round, each of you can share a specific thing that contrasts you and what you offer, right, from the others. You got a chance to hear from everybody. And I'm doing this partially, it's kind of fun to kind of wrap things up, but also I think it's good for our audience because they just heard 4 very different and somewhat similar solutions. So as they walk away from the podcast, walk away from the webcast today, how will they remember what's different about you? All right. So I think you have the order on your side, so I won't be shocking you, but we're going to start with Joe. What's your one thing you want people to take away?
So I want people to take away today the choices that you have at Nationwide with our 2 hybrid solutions on an individual and a joint long-term care basis. So you've got options at Nationwide and know that everything that you see at Nationwide is going to be 100% guaranteed with our cash indemnity benefits and our flexible premium options.
Perfect. Thank you, Joe. Rob, what about from Lincoln?
Well, certainly going back to having no deductible, no elimination period, and having a choice of indemnity or reimbursement. And if you choose indemnity, that actually will extend out your benefit period by 20%. So having that choice and not even needing to make that decision until the time of claim, it really makes us unique in this space.
Love it. Kimberly, how about from John Hancock?
Gosh, we're so different. It's tough to choose one, but if you're going to make me choose one, I'm going to go with the fact that we are going to have the largest death benefit, anywhere from 2, 3, 4 times my friends on the screen when they get to average age at claim or life expectancy. And that's simply because, again, our death benefit is growing right along with the LTC benefits over the course of the policy, which, since we know that 30% of us will get lucky and pass away not needing long-term care, it can really help your clients with moving forward with the application process, because you are going to have those clients who feel like they may not need long-term care at some point in their life, so they won't find as much value due to the lower leverage on the death benefit side. But since our death benefit is growing, they'll get both meaningful long-term care but also meaningful death benefit. So more clients are going to find value from both aspects of it, especially with those couples, right? Females on board, wants to get the LTC plan in place. Husband's pushing back, has his arms crossed, says, nope, that's not going to be me, right? Now with a more meaningful death benefit, you're likely to have the solution that they'll both jump on board with.
Love it. Thank you, Kimberly. Mr. Tim, how about Securian? What's the unique feature you'd like to leave people with?
SecureCare 3, I'm just so thankful to work with such a simple product, right? It's simple, it works, it's incredibly powerful, again, in those short pay, single life scenarios. So really, when you're working with your clients, that's really where we're going to shine, especially, compared to where the industry is and the marketplace is today, is really a simple policy design, providing a lot of leverage with a very, very flexible cash indemnity benefit.
That's perfect. Well, folks, you've had a chance today to hear from 4 experts in the industry. And as I said on the onset, this is a sample of four of the organizations that we do work with in the long-term care hybrid LTC space. And there are others that we have as well. But we felt that this provided a good representation of who in the market is out there and what they offer. Now, I want to make sure to mention to you that we have resources that can really help you here at DBS. We have a linked benefit resource center on our website, and you can see it right now. And you can also see that we have a linked benefit training resources, and they're all out on the DBS website. So if you have questions, check out our website, or please call our case design team. They'll walk you through the products. They actually have, believe it or not, access to all the people on our call today. And if they have a product question they can't answer, they will get our experts on the line with us to help you help your clients. Folks, each one of you, I just can't say enough thanks to each one of you for being with us here today. Joe, Kimberly, Rob, Tim, well done. Many thanks to each one of you. Thank you. Thank you so much for being with us. And thank you to everybody out there for taking time out of your busy day to join us for another edition of Sales Accelerators. We hope you have a great day, and we look forward to seeing all of you back here real soon. Take care, everyone.